Morning. Top Gun here, Friday, March 5th, about 3:40 a.m. Pacific Standard Time. This is the YouTube pre-market commentary. Section 1, technical damage mounting. All right, so the stock market got hit yesterday as the 10-year yield rose another 8 basis points to 1.55%. So it's now up 35 basis points in the last 3 weeks. The S&P was minus 1.34%, the NASDAQ minus 2.11%, and the Russell minus 2.76%. As you can see, I've included an intraday chart. It was kind of just humming along the first 2.5 hours, looking like a consolidation day, and then the bottom dropped out from 9 a.m. to 11 a.m. Pacific Standard Time with a little bit of a bounce in the last 2 hours of the day. The S&P closed 50 points below its 50-day moving average. The NASDAQ closed below 13,000 at 12,723 and is now negative year to date. The QQQ is now at the levels where it was on the intermediate high it made on September 2nd, 2020. So it hasn't made any progress in the last 6 months. The ARK Innovation Fund, ARKK, Kathy Wood's fund, which has been the leading ETF, really one of the leading vehicles in the market for the last year, is now down almost 25% over the last 13 sessions. So the technical damage is certainly mounting. However, the crowd is unconcerned. To them, it's just a correction. I read a number of tweets yesterday talking about how little the S&P is off its highs, calling the correction healthy, making fun of hashtag stock market crash trending on Twitter, and comparing this correction to the correction in September 2020. So the crowd is viewing this as a correction within an ongoing bull market, which means that they will at some point try to buy the dip. I've included a number of tweets here where you can see this sentiment expressed. Now, it always takes the crowd longer to understand what's really going on. There's only, the elite that can really see early that a regime change is taking place, and so like I said, you can expect the crowd and most people to try to buy this dip, but it will fail this time. It's worked for 12 years, but this will now be a counter trend move in a bear market rally, not a correction in a bull market. Okay, moving on. Value greater than growth, part 2. Talked about this yesterday, but I wanted to talk about it again because Steve Straza of All Star Charts had a superb blog post illustrating this rotation from growth stocks into value stocks with technical analysis. It's just packed with charts and analysis. Highly recommend that you read it in full yourself, which I've linked to it in the blog post. But for our purposes, his chart showing the Russell 1000 value ETF, the IWD, breaking out, while the Russell 1000 growth ETF, the IWF, breaks down, encapsulates the post. That's what's happening. Now, Straza doesn't seem to be concerned about the implications of this for the overall market, but he should be, because value is too small of a proportion of the market cap of the major indexes to carry them higher. So if growth is truly rolling over, and I believe it is, so is the bull market. All right, lastly, let's talk about Broadcom earnings from yesterday afternoon. The report itself looked fine to me. All right, my bike is going crazy here. Let's just stop that. The report itself looked fine to me. Revenue was up 14% and non-GAAP diluted EPS 26%. They also guided the current quarter revenue to plus 13%. So, the numbers look fine, but the stock was off 2% in the pre-market last time I checked. And if you look at the chart that I've included, Broadcom was essentially at all-time highs at Monday's close, and now it's had 3 nasty days, looking at a 4th nasty day. So it went from being at all-time highs to almost essentially complete breakdown. And Broadcom is an important stock in its own right at almost $200 billion market cap. And it's 5% of the very important Van Eck Semiconductors ETF, the SMH. All right, guys, that's it for today. Good trading out there. I'll see you next week. Top Gun out.